Over the last 5 years, this stock delivered returns exceeding 600%, drastically outperforming the broader index. Management, however, points to a pivot toward high-margin products and international acquisitions as the foundation for future earnings. The subject is Man Industries. They are a mid-cap industrial manufacturer operating with a current market capitalization of 4,169 crore rupees. To verify if that projected growth is mathematically grounded, we are executing an uncompromising institutional-grade audit. We will test their fundamentals, forensic accounting health, and technical price action. We are going to answer one question. Can Man Industries mathematically justify a 15% compound annual growth rate over the next 5 years? This image anchors the sheer scale of the total addressable market. Man Industries supplies the heavy physical infrastructure required for the global oil and gas sector, as well as massive domestic water transmission networks. Past price momentum means very little in heavy manufacturing. To survive this audit, the company must prove its future growth potential through verifiable order books and funded capacity expansion. This factory floor illustrates the immense capital expenditure required to maintain their legacy revenue stream, manufacturing submerged arc-welded line pipes and aluminum extrusions. Future earnings are built on 3 distinct pillars. Pillar 1 is an executable order book standing at 4,100 crore rupees, bolstered by a recent 1,000 crore order win. Pillar 2 introduces a shift toward high-margin products, allocating 5.9 billion rupees for a new stainless steel facility in Jammu. Pillar 3 secures global expansion for Man Industries. They recently executed a $102 million acquisition of the National Pipe Company in Saudi Arabia, locking in Middle Eastern supply chain integration. Based on these catalysts, management has issued aggressive forward guidance for FY27, projecting total revenue between 5,000 and 5,500 crore rupees, with EBITDA margins expanding between 13 and 15%. There is also a non-core real estate catalyst in play. The Merino Shelters project monetization is expected to yield between 800 and 900 million rupees in direct profit over the next 3 to 5 years. These 3 pillars are transitioning Man Industries from a standard domestic pipe maker into a globally integrated, high-margin supplier. We now need to test if the balance sheet supports this narrative. This dashboard maps 3-year revenue against net profit to establish our baseline. Over FY24 to FY26, data shows healthy revenue and PAT growth holding steady. These dials track return on equity and return on capital employed, confirming capital is deployed efficiently. The trailing price-to-earnings ratio sits at 24.4 times, significantly higher than its 19.1 historical average. On past performance, the price is disconnected. But applying analyst estimates targeting a 629 rupee fair price, the 1-year forward PE plummets to 16.9, inverting the valuation model. We apply the enterprise value to capital employed multiple, measuring total value against actual working capital. Analysts assign a conservative 1.3 times multiple. Scaling operations requires aggressive capital expenditure, risking over-leveraging. But Man Industries maintains a 0.38 billion rupee net cash position, safely containing the debt-to-equity ratio. The trailing metrics look stretched, but forward-looking multiples build a compelling argument for undervaluation, assuming management perfectly executes their capex plans. Paper profits are easily manipulated. We must map profit after tax against cash flow from operations to verify the company generates actual free cash flow. We also audit the working capital cycle. By tracking debtor days and inventory days, we ensure cash isn't trapped in stalled supply chains or unpaid international invoices. Shareholding data reveals strong institutional backing. Foreign and domestic institutional investors hold firm, while smart money veterans like Ashish Kacholia actively maintain a 3% stake in the company. Next, we check promoter pledging. High pledged shares leave a company vulnerable to margin calls, so we verify promoters haven't irresponsibly leveraged their own equity. To ensure audit integrity, we compare 5-year growth in auditor fees against revenue and PAT growth. Disproportionate auditor compensation is a standard red flag for financial engineering. We apply standard compliance checks. We scan filings for vague system scopes, undefined controls, or abrupt auditor changes that suggest shoddy reporting practices. Finally, we assess customer concentration. A massive order book is useless if dependent on a single client who could shatter the cash flow cycle. After running these forensic tests, the data yields a clean bill of health. The profits are cash-backed, and there are no hidden systemic risks. This institutional peer matrix benchmarks Man Industries directly against its primary competitors, Maharashtra Seamless and Venus Pipes. In heavy manufacturing, banking ratios like gross non-performing assets are useless. We evaluate capital intensity strictly using price to book and return on assets. When we align price to earnings, market cap, and profit growth, the data highlights exactly where Man Industries is outperforming rivals in operational efficiency and asset returns. Zooming into quarterly data, sales are down year over year, but jump 39% quarter over quarter, confirming management's aggressive pipeline is already materializing in current data. More importantly, the company is executing its EBITDA margin expansion, chasing a 728 basis point jump, while it simultaneously drives quarter-over-quarter debt reduction. The peer analysis and quarterly momentum show Man Industries is capturing a larger percentage of current demand through superior capacity deployment. Financials tell us what a company is worth. Price action tells us when the market realizes it. We need to check if smart money is validating the fundamentals on the 1-year, daily, and weekly charts. Here on this candlestick chart, we plot the current market price of roughly 555 rupees against its 52-week high of 623 and its low of 302 to establish the current trend boundaries. We overlay the 20, 50, and 150-day moving averages. These trend lines map the exact support levels where institutional buyers are actively defending the price and maintaining upward momentum. But the critical metric here is liquidity. The stock is recording massive delivery volumes, 62. We arrived at this audit with a central tension. The trailing PE suggests the price has outrun historical performance, but the forward earnings estimates and the massive order backlog indicate future growth is not yet fully priced in. The future valuation relies entirely on 3 specific variables: the successful integration of the Saudi Arabia facility, the rollout of the high-margin Jammu stainless steel plant, and strict execution of the existing order book without cost overruns. When we plug those executed variables into the forward valuation equation, the current price and guided earnings mathematically support a 15% compound annual growth rate over the next 5 years. Because the forensic audit clears the balance sheet of systemic risk and the technical volume confirms institutional support, the confluence of data secures a firm buy rating. In mid-cap industrials, outsized returns are never found by analyzing trailing data. They are secured by accurately mapping the execution of high-margin capacity expansions before the broader market prices them in.